Cancel dinner plans. Turn off the TV. Forget the weekend. Because if you're watching this, you didn't come for entertainment. You came because something feels off and you want to know why. You came because somewhere deep down you already sense that the system just blinked. And when a system this big blinks, people lose everything. While most of the world slept, while social feeds scrolled and sports highlights replayed, the financial backbone of the West didn't crash. It didn't collapse in flames, it hesitated. And hesitation inside a high-speed automated market is far more dangerous than an outright failure. A crash is obvious. A pause makes you question whether you're imagining it. It's Saturday, January 31st, 2026. Markets are shut. Trading desks are empty. This is normally the quiet part of the financial week, the moment when the machinery reconciles itself. Clearing houses run their end-of-day cycles. Ledgers balance. Reports are finalized. Ownership is confirmed. It's the unglamorous plumbing that keeps everything else from flooding. Except today, that plumbing isn't just leaking, it's glowing. For the last several hours, analysts have been watching live data feeds from CME Group, the Chicago Mercantile Exchange, the beating heart of global derivatives trading. This is not a regional venue. This is where the world prices risk, and something that simply does not happen, happened. The data stopped speaking, not a power failure, not a scheduled outage, an informational blackout. Delivery notices won't populate. Issues and stops, data that tracks real physical movement, are blank or frozen. Some fields show zeros where values should be. Others show timestamps that are days old. And this silence lands right on top of the most violent, dislocating week the gold market has ever seen. If you believe that timing is random, this video isn't for you. Because what we're looking at doesn't smell like coincidence, it smells like theft. To understand why this matters, you have to know what's missing. Every day, CME publishes two core sets of numbers. First is volume, how many contracts changed hands. Buyer meets seller, paper trades. The second is far more important, issues and stops. That's the record of which contracts demanded actual metal. Not cash, not rollover, physical bars leaving vaults. Those two numbers must reconcile. Always. If 100 contracts stand for delivery, 100 delivery notices must appear. That's not optional, that's arithmetic. But for the last 2 weeks, those numbers have drifted into nonsense. Volume screams movement, delivery data whispers nothing, and today it didn't even whisper, it vanished. CME's response was a familiar phrase, technical reporting issues. That's corporate code for something far worse. We don't trust our own ledger. Some will shrug and say it's a software hiccup, a weekend glitch, something to be patched by Monday. That thinking misunderstands what CME is. This is not an app. This is not a streaming platform buffering under load. This is the settlement spine of the global economy. Billions are spent here on redundancy, audit trails, and cyber defense. Systems like this do not glitch during a multi-million-ounce delivery cycle unless something has gone catastrophically wrong. That's not bad luck. That's motive. To see what might be happening, you have to stop looking at official statements and start listening to whispers, specifically the ones circulating through cybersecurity and intelligence circles about a group known as Salt Typhoon, not a storm, a code name. Allegedly, a state-backed Chinese cyber unit that's been burrowing into Western infrastructure for months. Telecoms, power grids, water systems. Everyone talked about lights going out. Nobody asked the more dangerous question, what if the target wasn't electricity, but settlement? Here's the nightmare scenario now spreading quietly across dark forums and private risk calls. What if Salt Typhoon didn't attack CME to break it, but to use it? Imagine the modern version of a heist. No masks, no vault drills. You compromise the matching engine, you alter order priority. You insert logic that lets your delivery demands clear first, every time. Then you suppress the reporting layer so no one sees metal leaving in real time. Bars are removed, vaults drained, but the dashboard still shows full. That would explain everything. The silence, the zeros, the frozen timestamps. The reason CME can publish today, maybe because the system is trying to reconcile an impossible truth. The database says metal exists, but the shelves don't. When code meets reality and they disagree, systems crash. So what do you do if you're running the exchange? You don't publish, you stall, you cite technical issues. You buy time, 48 hours to locate metal, rewrite entries, secure emergency liquidity, or beg for institutional support. You patch the hole while the water's already at your knees. But markets are animals, they smell fear. And when data goes dark, liquidity usually has already left the room. You don't hide numbers when business is good. The confirmation that this is systemic, not clerical, comes from price behavior. Arbitrage should still function even if reports lag. Bots don't wait for PDFs. They feed on milliseconds. Yet those bots have gone silent. And the proof is the spread. That is not inefficiency. That is rupture. That is the bridge between paper and physical snapping in half. In functioning markets, spreads this large cannot exist. Algorithms are designed to erase them instantly. If gold is cheaper in one city, machines buy there and sell elsewhere until prices converge. It's frictionless, constant, and ruthless. So why hasn't this gap closed? Why is a $283 bill lying on the sidewalk untouched? Because the second step of arbitrage, delivery, has failed. Buying paper is easy. You'll get cash instead, if you're lucky, while Mumbai trades higher without you. So the bots are off. Kill switch is thrown, liquidity withdrawn. That means arbitrage is dead. And when arbitrage dies, global pricing dies with it. There's no longer one gold price, only a paper illusion in New York and a physical truth in Asia. Silver tells the same story, London versus Hong Kong. A $13 spread, that's over 10%. Normal is pennies. This isn't volatility, it's immobilization. Metal is trapped, flows are frozen. Velocity has collapsed to zero. This is what systemic seizure looks like. Blood stops circulating, extremities go numb, tissue begins to fail. We are watching paper price discovery flatline in real time. Why this weekend? While CME claims reporting issues, major bullion banks in Hong Kong have suddenly entered emergency system maintenance. Withdrawals delayed, allocations pending, exports frozen. The official line is cybersecurity compliance, routine updates, but the timing is surgical. A new law went live in Hong Kong on January 1st, 2026, the Protection of Critical Infrastructure Ordinance. It grants sweeping authority to lock, freeze, or assume control of any system deemed essential during a cyber threat. Financial clearing, vaults, settlement layers, all covered. Connect the dots. A cyber incident hits U.S. markets. Hong Kong declares elevated threat levels. The ordinance is invoked. Vault doors close legally. This is a siege, executed with paperwork. Metal enters Hong Kong and doesn't leave. A one-way valve, a roach motel for bullion, and the market knows it. That's why silver trades $13 higher there. While the West hides emptiness, the East locks abundance. A coordinated pincer, and stuck in the middle is anyone short metal. If you bet against silver, you're now cornered. You can't source from CME, you can't source from Hong Kong. There's no exit. Pressure builds with nowhere to vent, except price. If delivery becomes impossible due to cyber events, contracts can be settled in cash. But reopen. We are currently in the eye of the storm. Screens frozen, data dark, vaults locked, but the clock is ticking. When electronic trading resumes Sunday night, this pressure won't ease, it will snap. With no sellers and desperate buyers, price must gap to the level where someone finally lets go. For silver, that could mean a $20 jump in minutes. Not dollars, tens. Short sellers will panic. Buy buttons will be smashed without regard for price. And who sells? Almost no one. Dealers are frozen, unless the nuclear option is chosen. Trading halts. Cash settlement only. A silent default. If that happens, the check you receive is not a win, it's a confession. It means your contract was never backed by metal. And when those checks hit accounts, that cash will rush toward physical markets already stripped bare. A bifurcated world emerges, frozen exchange prices and runaway street prices. This chaos isn't about Salt Typhoon anymore. Real or not, the damage is done. Trust is broken, the bridge is gone. Which brings us to the reality for you. Cyber incidents are the perfect cover for insolvency. Freeze withdrawals, cite safety, and call it protection. Capital controls without legislation. If you hold paper claims, ETFs, unallocated accounts, futures, you're exposed. You're holding a ticket to a coat check that just burned down. Best case, you're paid in weakening currency. Worst case, you wait indefinitely. This weekend delivered a brutal lesson. If you can't touch it, you don't own it. Digital ledgers can be altered, systems can be turned off, but atoms don't respond to malware. The West is dimming. The East is locking doors. Liquidity is evaporating. Price is about to discover truth, and truth is expensive. Ignore the headlines. The exits are narrowing.